Good day, ladies and gentlemen. My name is Dick Gerback, and I'm a certified financial planner. I'm also the founder and managing partner of Strategic Advisory Services, a company specializing in retirement income planning for those who are retired and those who would like to retire. I'm often asked what makes our company different than other firms in this space, and the answer is our process called Income in Stages, Money to Last. With that in mind, I have asked Jeremy Joyner, our Senior Certified Financial Planner, and Michael Wellings, our Director of Marketing Communications, to discuss this process. Thanks for listening. See you soon.
Thank you, Dick. My name is Jeremy Joyner, Senior Wealth Advisor.
My name is Michael Wellings. I'm the Director of Communications.
We are going to spend a significant portion of this presentation discussing our retirement income planning process. But first,
let's discuss our fiduciary standard pledge. This is a pledge that we as a firm take to our clients, and what it means in a nutshell is that we do our best efforts to put our clients' interests ahead of our own. There's a few different iterations of how this is played out on the slide in front of you, but what I want to highlight is that this is not an industry standard, this is our standard, and it's something we're very proud of.
So our retirement income planning process is a little over a decade old in implementation. We have many clients that have gone through that are in this process, and what we're sharing with you today is a very high-level overview. What we want you to know is that this is a very customized planning process. Every iteration looks a bit different throughout the entire plan, and certainly yours would as well. But as we go through this, if there's any questions, please feel free to give us a call, send us an email. Our phone number and email will be at the end of this presentation. Let's start with the 5 big risks in retirement.
Right. So in retirement, we've seen the retirees face about 5 really big risks. And the first of these is an increased life expectancy risk. In the past, you could bet to live maybe about 20 years after you retire, about at 65, 67. Nowadays, we like to plan for a 30-year retirement minimum.
And the things you buy are going to get more expensive. This is inflation. The things you purchased in 1980 were certainly a whole lot cheaper than they might be today. For instance, a car. Back then might have cost you $4,000 or $5,000. Today, easily $25,000, $30,000, maybe even $40,000 for that same car.
The third is healthcare risk. Healthcare poses one of the biggest costs that people face in retirement. One of the good things about healthcare is that technology is increasing. People are being able to live longer, we're able to combat diseases more. Unfortunately, that comes with an increased cost, and it's something to plan for.
The big elephant in most retirement income plans, and probably the most talked about topic, is the stock market or market risk. We know that markets markets go up and down every single day they're open. There's a 50% chance it will go up and a 50% chance it will go down. So it's very difficult to predict what the market's going to do over a short period of time. However, much more predictable over a long period of time. And we like to use this to our advantage in the planning process.
And the fifth is providing financial support for other family members. This is played out in a really popular movie called Failure to Launch, and it's about a 40-year-old man who still lives with his retired parents, and their parents totally support him. It's a comedy. It's a great movie. If you haven't seen it, I highly encourage you to. But it makes fun and makes light of the fact that retirees nowadays are increasingly having to provide for unlaunched children, or even perhaps some aging parents of a spouse, your own aging parents whose resources have run out.
So in the planning process, we're going to discuss and highlight each of these 5 big risks as we go through. But so Michael and I have done lots of videos together, and one of the things we know is that the attention span of most folks lasts about 2 to 5 minutes. And so we're certainly pushing that here. And so we encourage you to give this a chance. We know it's long, at around 20 minutes, but it's certainly worth your time. And if you are retired, maybe it's a different solution to providing your retirement income. Or if you're planning and considering retirement, maybe this answers some questions you didn't even know you had. So we look forward to going through this with you. And of course, as always, ask any questions, and our information will be at the end. The traditional approach to retirement income in the fee-only world, in the investment management world, is the 60% stock, 40% fixed income asset allocation. So what I mean by fee-only investment management world is insurance companies have created different types of products, annuities, things like that that attempt to solve the income problem. We're usually not a fan of those because they will tie your money up for long periods of time. They're very expensive, and in a lot of cases, they don't meet the promises they make. So it's usually in someone's best interest to consider other types of approaches. So in our space, the fee-only space, the 60-40 portfolio has been the answer. You go to 10 different investment and financial advisors, you might get 9 different versions of a 60-40 asset allocation. Simply, it's allocating 60% of your assets to stocks, 40% to fixed incomes, bonds, cash, and cash equivalents. And the industry says you can take out 4 to 4.5% of that out each year and increase that with inflation. And so the rationale is fairly simple. If this 60-40 returns 7% on average every single year, and you only take out 4 to 4.5%, your portfolio grows by 3 to 3.5% each year, therefore keeping pace with inflation. But Michael, does it play out that way?
No, that sounds great, but you can't bank on 7% return every single year, which is what this needs.
Right, returns happen in random ways. So some years are very good, other years may be very bad, some years are in between. We call that the sequence of returns, and it matters quite a bit in someone's success in this traditional 60-40 approach. So we believe that approach doesn't really account for some problems that you're going to face along the way. Number one is inflation. We have found, looking back at 2008, 2009 with that Great Recession, that while yes, the market recovered, people in this traditional approach in all likelihood did not recover with it, because while the market was going down, they're selling shares of stock to produce income. And yes, the value of the stock came back, but if you don't own as many shares, your portfolio doesn't come back with it, and thus you continue lagging inflation over a long period of time.
Yes, selling shares of stock is a key concept because you sell shares of stock to provide that income, and you need more income if disaster strikes. What happens if 5 years after retirement, 10 years after retirement, you get a cancer diagnosis? What happens if 5 years after retirement, we have another Hurricane Harvey and there's 3 feet of water in your house? You're going to need to generate that income, and in many cases, the 60-40 is unable to do that adequately.
Yeah, a good retirement income plan can deal with the what-ifs. And they also have to deal with long-term care. So long-term care is health care costs above and beyond what your medical insurance will cover, typically later in life. Things like nursing home, home health care, assisted living. There's certain statistics and numbers out there. They're fairly high. A person can expect to spend $40,000 to $70,000 a year, depending upon location, if you're in a nursing home and you're paying out of pocket. And so there's insurance out there to help with that. Insurance can sometimes be very cost prohibitive, or maybe you don't qualify for it. But it's a conversation that what you need to have with an advisor as to how your plan will deal with long-term care. And it's one we certainly have.
And finally, could you afford to ride out a bear market? We're talking about selling shares of stock to provide income. Well, what happens if the market takes a dive and you have to sell more shares of stock to provide that same level of income? Well, you sell more shares of stock when that market recovers. You're not going to have the same amount of shares. You're not going to have the same amount of money in your portfolio.
So we're going to camp out on bear markets for a little bit, because there actually is a definition of a bear market, and that's a 20% drop from a previous high. The last bear market we had is illustrated at the bottom of this chart. And it started in 2007, ended in 2009, lasted a year and a half, and it was a 57% decline from the previous high on the S&P 500. So when we talk about bear markets, we're talking about those big 20% drops or more. And we've had many of these over the years, and as this chart illustrates, every single time we've had one of these bear markets, the stock market, the S&P 500, has recovered. It was just a matter of how long it took. The reasons were always different, but the time it took to recovery is a huge factor in whether or not a person can be successful over a long period of time in income mode in retirement. Another thing to note from this chart is it would be crazy for us to build a retirement income plan assuming that we're not going to have more of these in the future. So if you're 65 and you're thinking you might be retired 30 years, which we sure hope you are, And that could mean you might go through 4, 5, maybe 6 of these bear markets throughout your retirement, which are frightening experiences, but they are a reality. So this is a different look at some asset class returns going back 2017, which is in the far right-hand side of your screen, and then it goes back to 2008, and it illustrates first the S&P 500. The S&P 500 was down 37% in 2008, and since then has been positive pretty much every single year. So we're 9 years in to almost 10 years into a bull market run. We are going to have another one of these bear markets. It may not happen tomorrow. It might take another couple years, but your plan better be able to deal with that. Another thing to note with this chart, as it's illustrating a bunch of different asset class returns, is if you're trying to predict the best place to invest at any given time, if you want to try and play that game, the whole market guessing game or market timing, I'm going to try and get in at high points or get in at low points, get out at high points, you've got your work cut out for you, because history tells us it's almost impossible to do. You can just look at this chart in different asset class returns and you'll notice it's completely variable and almost impossible to predict. Every single year there are bad places to invest money. And the bad places tend to be where people are because they chase returns. Hey, emerging markets did really good last year, I'm going to invest in it this year. Well, it actually might be the worst performing asset class this year, and you typically find yourself behind the 8 ball. We don't play that game. We believe in strategic asset allocation, globally diversified. So what is our solution to this income problem?
Well, our solution is a process that's been around for about a decade. It's called Income in Stages, Money to Last. So what we do, we take your IRA, your individual retirement account, and instead of having that one big 60-40 portfolio allocation, we're going to take your retirement and we're going to break it up into 6 separate stages, with each stage equaling 6 years.
Yeah, so stage 1 is the first 6 years of retirement. So if you just retired last year, you're in stage 1 of retirement. Stage 2, years 7 through 12. And as they pop in here, so stage 5, years 25 through 30. And legacy is a 30-plus year stage in retirement. So when we discuss stages, Michael, if somebody's in year 15 of retirement, what stage are they in?
They are going to be in stage 3.
So in stage 3 of retirement, so if you're at the beginning of retirement in stage 1 and you're investing for something that's not going to happen for 15 years, how should you invest, right? Should be different than how you invest for your assets needed in stage 1.
Oh, well, absolutely. Well, as you mentioned, people who retire now, if you see a 30-year retirement picture, you're going to have these bear markets, but you do not know when these bear markets are going to hit.
So the first principle of our planning process is that you should not invest aggressively for the assets that you're going to need for that first 6 years of retirement. You should keep those more conservative, but you might consider being much more aggressive. We would recommend it for assets you're going to need 15, 20, 25 years in the future, and that's where we're headed in this presentation. So stage 1, we call that the income stage, the characteristics, the planning process. First, we're going to go through and we're going to try and determine what does the first 6 years of your inflation-adjusted living expenses look like, which involves a budgeting process, which involves looking back at previous expenditures, pay stubs, things like that, trying to determine what does that lifestyle look like. And then so we're going to invest usually in 90 to 100% fixed income, cash equivalents for that particular stage, because we frankly don't have much of an idea of what that market's going to do over that first 6 years. It could go down, could go up. We don't want to play or gamble with anyone's assets in that short period of a time.
Right, and that being said, we want to highlight that the goal for this stage is income, not growth. That's what the later stages are for that we're about to talk about. You might be saying, well, why? I want my money to be working for me. Well, what we're trying to do is avoid market volatility as much as we can. We don't want to play with the money that you have to have for the next 6 years, because in the event of a bear market or a recession, those needs are going to be better protected against the downturns that may happen. And ideally, as we mentioned in that slide that went over bear markets, they can last anywhere from, I think the shortest one was 3 months and the longest one was
Several years.
Several years.
3.5, 4 years.
So this ideally would give you adequate time to ride out bear markets or recessions to get to the flip side of that downturn.
Yeah, so that describes stages 2 through legacy, what we call the growth stages. So stage 2, again, is years 7 through 12 of retirement. So when you're in the beginning of a retirement income plan, how you invest for years 7 through 12, right, are going to be different than how you'd invest for years 1 through 6. So each stage has a different asset allocation. And here's the typical approach. So stage 2, years 7 through 12, maybe a 40% stock allocation. Stage 3, 60% stock, again, years 13 through 18. 4, 5, and legacy. So you can see stage 5 and legacy are 100% stock. And you may think to yourself, gosh, I'm 100%, that's super volatile. I don't know if I can handle that. But you got to think back to how you might have invested money 30 years ago. So Michael, you just started your career and with your 401k. How do you go about investing your 401k?
Oh, as aggressive as possible.
Right. Why?
Because I know that over time, in the past, markets have trended upwards. And I think that that is going to continue into the future.
So you've got the time horizon necessary to be aggressive with your investment strategy.
Right. I have no doubt that I'm going to experience bear markets. No doubt at all.
But because of your time horizon, you can recover in your 401k, hopefully, if history just tells us anything, that should grow.
That's right.
Right, over a long period of time. So we take that approach when it comes to these latter stages, 4, 5, and legacy. This is the efficient frontier. It won the Nobel Prize back in, I think it was in the early 90s, because it put in relationship risk and return in graphical form. Bottom line, to achieve return, volatility, risk has to be taken. And when it comes to efficiency, what we're discussing is achieving the maximum return for the level of risk volatility that you're willing to take. An inefficient portfolio is one in which you're taking volatility and risk on, but you're getting a very low return for it. That inefficiency in nature is typically created by bad investor behavior, poor asset allocation, maybe chasing returns, trying to market time, things like that. So we try and build structured strategic asset allocations that fall on this efficient frontier. So for your stage 2 assets, as illustrated here, we want to make sure, as this line represents, that you're getting the most return for the level of risk you're willing to take. Of course, in the perfect world, you can invest in this corner where you achieve the maximum return possible and take no risk. But does that exist?
No, it does not.
No, it doesn't. It doesn't exist at all. That's typically how advisors find themselves in jail. They basically make guarantees and promises they can't possibly keep. In this particular case, this efficient frontier over here on the far right-hand side represents a high level of return, but you have to be willing to take on a high level of volatility. In our experience, you can only take on that level of volatility when you have the time horizon to do so. 25, 30 years is certainly a recommended time horizon for a aggressive strategy. So moving forward in this presentation, in this discussion, you might think, well, what happens after stage 1 is complete or a 6-year period ends?
Right. So as we mentioned, each stage lasts 6 years. So say you choose to do this plan. 6 years goes by and you say, okay, well, what happens to my funds now? Well, what we do is we rebalance your portfolio internally. Stage 2 is going to become the new income stage. And so if you recall, stage 2, they're typically about 40% equity position. It's going to be shifted to a 90 to 100% fixed income cash and cash equivalents position to protect your income needs in the event of a bear market.
And then each other stage, stages 3 through legacy, are typically shifted down the scale and asset allocation structure as well. So again, stage 2 becomes the income stage, 3 becomes 2, 4 becomes 3, 5 becomes 4. So as you get older, you get a little bit more conservative, but we're still trying to maintain about a 60% stock overall strategy. That's the inflation protection, but what we're not doing is selling shares of stock to provide income. So this goes through a little bit of a structured analysis of what a plan might look like. So stages 1, or years 1 through 6 in stage 1, you've got all 6 stages filled. 6 years passes, now you've only got 5 remaining. You'll notice stage 2, 3, 4, 5 are all each reallocated down one step in the asset allocation structure. Of course, this becomes a new income stage. And we do that every 6 years until you're 25, 30 years in the future, and you've experienced a hopefully fulfilling, long retirement, and you're in what we call legacy mode. Legacy does a couple things. Number one, it provides longevity protection. If you live longer than you expected, there should and hopefully be assets there to provide for you. Or if it was a goal of yours to leave what you started with or a significant sum of money to your heirs, legacy can hopefully meet that obligation as well. And the funny thing is, though, most of the folks we deal with don't really want to do that. They say if there's any money left, or that there's a problem, or that last check better bounce at the funeral home. So, but again, we still want to plan and build a legacy stage in case you live longer than expected, or finally, if there are any unexpected financial emergencies in retirement. And there will be. Let's just be real with everybody. You're gonna run into some things that you just didn't see coming, and legacy is a great place to help provide for that. And so the 5 big risks that we're trying to address.
Right. We try to address market risk, trying to minimize it by the allocation of the portfolio. Increase cost of living. We're trying to index your retirement needs on an annual basis to protect it from inflationary pressures. Life expectancy with this plan, with this legacy stage, there's a much greater chance of your assets outliving you. And it also provides you to leave a legacy to your family.
And the healthcare risks. So when we're in discussions, when our planning process, how we address the healthcare risk is unique to each individual situation. Some folks have very good healthcare coverage through a previous employer. Others might not have healthcare coverage at all, and so it's more of a Medicare situation. So it's an individual approach, but we will try and anticipate what that cost may be and split it out, maybe grow it at a little bit faster inflation rate. Every situation is unique, and certainly we'll discuss it. So what we want to do now, if you're a show me kind of person, is go through a sample client. John and Mary are 65. They are retiring. They've got about $1 million in assets, and they are going to receive, or expecting to receive, about $36,000 a year in Social Security. So we meet with John and Mary, and we start the planning process. We start talking, what are your needs? What are your goals? What do you want to accomplish in retirement? What are your have-tos? What are your want-tos? In their case, it's fairly simple. They want a $75,000 a year non-discretionary income stream, which means that's their have-tos. In order to pay the bills, keep the lights on, eat at the same restaurants, buy the same types of groceries that they're used to, they need $75,000 a year to do that. Their non-discretionary needs are about $10,000 a year for 10 years. These are the I want tos, and we typically add this in the beginning of retirement because it is usually more expensive. As you're younger, you may want to travel more, play more, do other things that you might not do you're age 75 plus in retirement. They want to plan for about $5,000 a year for 15 years to travel, and they want to leave $1 million to their kids as a legacy. So we go through and we start structuring out this plan, the income, starting with ages, Social Security age, what age they might take Social Security, the annual income needs. These are the non-discretionary needs at the $75,000 level. You can see we're trying to index those by 3.25%. We have over here the expected Social Security and travel and miscellaneous expenses built in. One of the things we like to be able to do is answer a question quickly, and that is, do I have enough? Not everybody's gone through a financial plan 20 years ago and knows that, hey, if I save $2 million or $1 million, whatever the number is, that's enough. A lot of folks come in here usually age 60, 63, 64. They're a year or two out from retirement, and it's kind of like, here's what I have. Is this enough? And we want to answer that question as quickly as we can. And of course, we've built in the legacy here. So this assets needed is very critical, because if it shows $2 million as we go through the planning process and they only have $1 million, we've got problems. And we'll need to get to the drawing board to figure out how to solve that gap, which we've done a lot of that as well. So this shows you the income streams, the $75,000 growing by inflation, the additional needs, any income available to offset these needs, and ultimately, what does the portfolio need to provide? So $90,000 in year 1, $56,000 in year 2, 3, 4, 5, and onward. You'll see that things are getting more expensive. That $75,000 a year lifestyle in year 1 looks more like a $100,000 lifestyle in year 10. I'd love to say that these are pay raises, but they're not. That's just inflation. So it's probably buying the same amount of stuff that they bought in year 1 in year 10. So we go through that process and ultimately we land on a portfolio recommendation. So instead of that traditional just 60-40, hey, here's the pot of money, let's just start ripping income out of it, we allocate, or we'd recommend allocating $300,000 to stage 1, all fixed income. Stage 2, 40% stock, about $238,000. And 3, 4, 5, and legacy. So ultimately they have 6 stages of assets, each more aggressive in asset allocation. In their particular case, the overall aggregate still is around 60% stock, 40% fixed income. So the industry doesn't necessarily have this part wrong. What we believe they don't have right is the structure of how the income is produced. And so if you're at all curious about what this might look like in real life, jump into this sample here. So go to our website. There's a link in our website where you can enter this sample client, csample01 SSLC 2018. Enter that username and password, and it will actually show you a sample client. What they see every single day as clients see that portfolio going up, maybe going down, but how that income is being produced. And finally, in a planning process, one of the most difficult things to do, if not impossible, is to make portfolio assumptions. Meaning, what do we think returns are going to be in the future in a portfolio? It's almost impossible to do that. We can look back and say, all right, a 60-40 has returned 7% each year, but that's a meaningless number because there's no guarantees it's going to do that going forward. So to try and answer some of the what ifs in this planning process, we use a Monte Carlo analysis, and we'll test the plan against 1,000 different types of stock markets. So what's a good probability, Michael?
A good probability is anywhere from 82 to 100%.
And so what that means is 800 to 1,000 of the scenarios ran in of the financial plan were successful. So that's at the 80% level. So at the 80% level, 800 of the 1,000. Now there's 200 that weren't successful, but you might ask, well, that makes me nervous. Those might be a bunch of outliers, some scenarios that just are very unlikely to occur. We like to target around 85%. And then what's going to happen to folks?
Life happens.
Yeah.
That happens not just to retirees, that happens to everybody.
If you're 65, you know as well as anybody, and you've been successful enough to consider retirement, that life's going to happen to you. The what ifs, the unknowns. Maybe you had some grandkids, or you had a child that decided they want to move to North Carolina. They have grandkids up there, and you want to go up there with them. Well, it's going to cost money. Can you afford it? So we would illustrate these types of plan changes to see how this probability of success adjusts. So if somebody comes in and says, yeah, we need to buy a $400,000 property in North Carolina where they only have a $200,000 property in Houston because real estate's much more expensive over there, or for whatever reason, we would illustrate that and say, all right, that $200,000 withdrawal from the portfolio, or $200,000 borrowed and paid back over time from the portfolio, affects your success in such way. Maybe it drops from 85% down to 75%, and you really probably shouldn't do the $400,000 home. This is the way, and so we do this regularly with folks. We meet with them on an annual basis at the very least to talk about what are your plans, what's happening in your life, and how has this probability of success changed. So thank you for your time and attention today. Of course, if you have questions, comments, give us a call, 713-977-3800. Email at us at info@sasoffice.com.
And guys, I want to point out a great resource for you, AskStrategicAdvisory.com. There are plenty of tools on there to help you out with retirement. We maintain a blog that covers a variety of topics, things you might find interesting, so we highly encourage you to go there. Thanks so much for listening. We hope you have a fantastic day.
Thanks, Jeremy and Michael, for your discussion on our process, Income in Stages, Money to Last. We hope everyone listening to this presentation found it interesting and possibly beneficial. we'd like to offer you the opportunity to come and discuss your situation without any cost or obligation. Please give us a call. Thanks for listening.